then we can send it to Dotan and Stefano, so that should be okay. Yeah, perfect. Hi, Hamad.
Hamad, can you hear us?
Yes.
Okay, Asmar, go ahead.
Okay, perfect. So guys, thank you so much. First of all, let me just open 3-4 documents so that we can quickly put the stuff. This sheet. Okay, so the first thing is, the most critical thing is operating profit before exceptional item. Okay, and you know the purpose of this session is two-pronged. One, that we all use the same numbers. First, we have the same understanding, and second is that we use the same numbers, right? So, okay, getting back to operating profit. Now, I hope you both can see my screen, right?
Yes, yes, we can.
Okay, so if I just ask a question, and why I'm asking this question is not to challenge you, but just so that we have similar understanding of this one. So this is IMI. Okay. So Sami, if you recall, this IMI has operating profit of 209.8.
That's true.
You can see that here.
Yes, we can see it, yes.
Perfect. Now, do you recall that which figure should we use in IMI? Imagine if we were doing IMI case, which operating profit figure we should use excluding the exceptional items, if you remember.
We have to go to the notes, I believe, and I can't remember, it's 4 or 5, where we actually need to use the gross profit for that.
Okay, now you know what my understanding is? My understanding was that we should exclude the amortization and impairment and service and investigation fines and everything. But what I'll come straight to the point. Okay. What the professor has done is, professor has used all that operating profit number which is not an IFRS number, because IFRS number is operating profit. That's one, 209.8. But while calculating the return on capital employed, you need operating profit divided by that one, right? So the operating profit that professor uses is excluding all the exceptional items here. So she uses, in fact, 266.3.
Really?
Which is, yes. And Sami, this is so interesting. Even yesterday when I was talking to Stefano, remember on our call, the operating profit that I was using in Atkins was wrong. And I'll prove it to you. Now you see, and remember these figures, 266.3, which is the segmental operating profit, okay? And then this one, 2.6. So 266.3 plus 2.6 comes out to be 269, roughly. 269. Professor uses 269 as operating profit. Now let me show you that. And so this is interesting. For 2008, she uses 269. On the other hand, for 2007, can you tell me how much does she use, Sami?
It has to be
given this
207.8.
Incorrect. This is what I thought this morning.
Shit.
And I banged my head against the wall, Sami, when I was in the office. And this is not 207.8. This is 207. It's 207.8 plus 1.7, which is other income.
Ah, the other income. Okay. And in 2008, we did not have the other income, right?
Yes. So which means and why she's including economic hedge contract gains and losses, because she says that economic, and just to tell you, let me go back to the professor now.
Contract is considered part of normal business. We will use the adjusted profit numbers for our calculations. Return on capital employed is operating profit before exceptional items divided by total assets minus current liabilities. As we only have information over 2 years and we want to make a comparison, we will use end values, as we do not have enough information to calculate the averages for both years.
I will stop here. If you see the screen, 268.9, which is 269. And here she is using 209.5, which is, sorry, oh God. If I go back here, 207.8 plus 1.7. That is 209.5. And she says here,
in 2008, we find 25.5%, and for 2007, 24.5%, which is a slight increase. The growth...
Okay, she's gone to. Now, this is one lecture which is a feedback of IMI in 4.9. There is another lecture, and after this I'll take you to another lecture. Remember when she was giving the lecture as a live session, and she got disconnected abruptly? That disconnected session was 70 minutes, and she got disconnected after 70 minutes. There is another session the same day. I don't remember whether it was a morning or evening, which I was not attending. The other session is 110 minutes. And this morning I heard that session where she explains which one is exceptional item, why these hedges, why this hedge, this economic hedge contract gains and losses, which means any other income or any other economic hedge gains or loss you should include in the operating profit. Okay, so now we are at consensus. Now with this I open my Atkins now.
Okay.
2013. You have my revenue, you have my cost of sale, gross profit, you have my operating profit 101.4. Yesterday I used 104.1, which was wrong. I should not have used that. Which means 104.1 is broken down into 3 elements. 109.8 plus exceptional item, which is the pension liability. It explains in note 11 that it's pension liability gain 4.3, and minus 10, which is the amortization cost of the intangibles. And if you add 4.3 and subtract 10, 109 comes out to be 104. But I should not use these two. So if in your companies exceptional item and amortization is coming, you're not going to take that. So ideally I should take 109.8. Okay?
Okay.
Agreed?
Okay, agree, yes.
And if you see my Excel sheet, I am taking here 109.8. This one, let me just highlight 109.8 for 2013. Okay. But I think, Sami, this is again incorrect. Why?
Why?
Because I have not included other income and other gains or hedges.
Do you have any?
So those, yes. Now see, and I need your advice on this. If you come down, you see these 2 freaking line items? Profit on disposal of businesses of non-controlling interest. Now remember these words. This profit has come by selling the non-controlling interest business 4.5 million and share of post-tax profit from joint ventures. These two, 4.5 and 3.8, should I add these two numbers in 109.8 and consider this as an operating profit, same way in which she is doing for IMI? Because she is also considering 2.6, which is hedges, gains and losses, and she's also considering other income, which happens to be 0, but that is another income. So if I go to page number 84, that explains this note 5 and 3. If I go to page 84 now, 84. Sorry, 81, not 84. Page number 81. Okay, now 81. 81 says, what is other income? Because to be honest, I don't know the definition of other income. The other income is number 5, which was 1.7 in 2007, right? In 2007, if you read down there, in 2007, the company sold its interest in Imagine, a company called Imagine in Hong Kong, based merchandising business, realizing a profit of 1.7 million. Which means that, Sami, other income is when you sell a business or sell an interest in a business and you get a profit. Now if I go, and that should be included in operating profit. Now if I go back to my company Atkins, it is saying profit on the disposal of business and non-controlling interest and share of post-tax profit from joint ventures. If I go to this number 9.
Note number 9, yes.
Note number 9, because I want to qualify whether these two freaking line items are in other income or not.
Okay.
Here is number 9. Seven, 8, 9. $4.5. So this says, on March 4, 2012, a sale of group's non-controlling interest 14% in RMPA Holdings Limited, subsidiary of blah blah blah, is a parent company of an existing. The interest was sold for a net cash consideration of 14.5. The profit was 7.6, which is up there. And then the profit on disposal after tax, they paid some tax or whatever, was 7.7. So finally it came out to be 4.5.
4.5, okay.
4.5. So now my point is, UK Specialist Hospitals Limited on 20. Okay, again this is UK Highway Services and Atkins Facility Management Limited. This is the group profit or whatever, but they have sold this business, and they have made this amount of money by selling this business.
So we need to include that part of the operating profit. Is that what you're saying, Asmar?
I don't know. I have still considered 109.8, but I'm thinking, all of us, this is not, Sami, this may not be important, what should I do? What's important is that we all should do the same thing. You understand what I'm saying? If we are, yes, I'm not focusing, because imagine that TA will not be able to look into all the reports, but he may pick out one report each. And all of us, if we need to make a mistake, so-called mistake, all of us should be making the same, because the premise is like for like. There is no right or wrong ratio. We can make a ratio we are making a comparison at an operating level. If we need to exclude other income, we can exclude other income. That's not a standard formula. You know what I mean?
Right, and it could be possible that in some other reports there might be no other incomes. You know, in your case, you did.
Or in other, yes. So all I'm saying is, right now I have not included other income. other income as in, where is the freaking thing? Other income as in, so just a second. Other income as in, I don't know this. Where is Atkins? Other income as in, if I go back to this, I mean, if you quickly open your annual report, I was thinking of checking out all the annual reports of you guys,
Sure.
like all other just,
but
then I thought.
Let me quickly open mine. I think I have here.
Yeah, but you understand my dilemma, Sami.
No, I understand. I understood you correctly, and thank you for calling up for this meeting. We want to have this clarity, because you're right. It could be possible, by the way, that she picks up one report.
Because imagine, Sami, if you are a TA and you know this problem, the first thing you're going to do is you're going to go to the income statement of all the 5, check with one calculation of all, and then you will say, oh, which means these guys are not in sync. One person has included, one person has excluded other income. Okay, they all have excluded exceptional items and amortization, but they are fallen prey to this other income thing.
Right.
I was just quickly checking my annual report, but in my annual report they don't have other income. But I mean, all of the adjustments they have written down are mostly costs or depreciations or amortization. They only have government grant income that they have reported of 1.1 million. I don't know if this is something which you should classify as other income. So they got it. They got a grant from the government.
And you can share this with us.
Because this is not coming from the operating continuing operations. This is not come from sales, because what we are comparing is
Question is like, what do we, because you're saying that some of the items she's considering, so all of the money that comes into the business is considered as part of operating profit. That's the conclusion we're drawing right now?
No, what we are drawing is the operating income comes from the operating activities of business, which is buying and selling.
Mm-hmm.
Other income is called other income because it is other. It is not part of the operating.
Mm-hmm.
Some like you see Atkins here right now. Atkins are not including this other income of 4.5 and 3.8 in operating profit, which they are right in doing so. They have considered it in EBIT. This profit before interest and tax is actually earnings before interest and tax, which is operating profit 104.1, whatever they are considering.
Plus the other income, yeah.
Yes.
So you're saying that you're questioning that whether we should consider these as part of operating profit?
We should not, and that's why I've mentioned in my explanation that we are taking operating profit, and I'll mention in there before exceptional items and I'll mention in there before exceptional items and other income, as we are comparing or interested only in the operating activities of the company. We are not interested in exceptional items. We are not interested in any other income from any other source other than the core business or the business operating activities, and we are not interested in any amortization or depreciation. So these 3 things should be taken out. Only then an engineering company can be compared with. Look, Hamad, conceptually also, say for example, I am a president of this big company Atkins, and I have stakes in 20 other companies in the world, and I sell those companies and show profit and say my operating profit is this much. I operated very well, and in fact, maybe in practice, actually I would have sold very less. My revenue from sales would have been less, or profit would have been less, but I have sold properties at 20 different countries. If I compare with your company, and you're a company who has done a lot of engineering services, sold a lot of engineering, your operating profit would show the real business operating profit. My operating profit will have more component of some other gains or disposal profits that I've gotten. It's not a comparison for like, right? When we are comparing the operating business of a company. That could be.
Oh, I understand.
You understand what I'm saying, right?
Yeah, I understand. Can you just quickly go back to what the professor has used? Because there it seemed like she is including some items. I can't remember if those items she included were directly part of the operations.
For both years.
Just a second. Here we go.
Exceptional items divided by total business. We will use the adjusted profit numbers for our calculations.
You see, she just said we will use the adjusted profit numbers for our calculations. And we know that adjusted profit numbers are not the IFRS numbers. Remember in our lecture?
So here she's using the hedge contract.
But she has explained elsewhere. She has not explained probably here.
Return on capital employed is operating profit before exceptional items divided by total assets minus current liabilities. As we only have information over 2 years and we want to make a comparison.
She doesn't explain it here. She explains it in the lecture section. Let me go to the lecture section and turn on the live session. She explains it in the live session well. Because here, in the live session, which is 106 minutes, this one. Okay, now, and I think the session, it starts at probably 60 minutes. Operating profit, you see, operating, okay, just a second. IMI financial. Look, you see here you go. Hamad.
Yeah.
Profitability, profit before exceptional items and other income.
Okay.
Now,
makes sense.
Let's see what she does.
That's the reason why I chose this annual report, because I wanted to show you that you have to do some of these adjustments. It might be the case that you find annual reports of companies that have higher than the exceptional items.
I can't understand this. Maybe I can look at it separately.
Yeah.
Okay, so we start. Basically, what we had to do, we went to the notes. In note 5, we found that information that we were looking for, where you could see the revenue, the cost of sales, going to gross profit, and then to operating profit. So we now have a nice overview of the different expenses and where they are. But again, those exceptional items are now spread out over cost of sales and selling and distribution costs and the administrative expenses. So what we have to do is now get those out, and then we can go and start doing the analysis, which is basically the analysis we can do also for other companies when we compare. Okay? Now, so we have corrected the numbers here, and you have seen those before. So we continue on to then the return on capital employed. And what we use as definition here is operating profit before exceptional items. Because we want to see how well the assets are generating a return. And what we see is that we're seeing an increase from 24 and a half.
Just to get back, she has corrected those numbers here.
Really?
Just a second. Corrected in the sense that here she's saying, okay, just a second, where is that screen? She's saying this screen at probably at 56th minute and 34th second, that screen shows 2008 figures before exceptional items. So before exceptional items, what she has done is this 268.9 figure that she has calculated. Look, this is different from what Amy is actually reporting as operating profit, which we have already discussed. And this 209, so 760 cost of sales, gross profit. So okay, but what she has done is she has directly put down the number of operating profit, which is 268.9. which we already know the 268.9, the number has come from here. She's actually copy pasting this line, this screen, this page actually, and here she has mentioned 268.9, which we know, which is this one.
You mean from the income statement?
Here's the income statement. So she has put in 266.3 plus 2.6, so which is 268.9. And here she has put 209.5. 209.5 means, and if you go to the next slide, this one, you see 209.5 is for 2007, operating profit less exceptional items. 209.5 is this one. 207.8 plus 1.7. So here she is adding other income.
Why?
That's the challenge. Hamad, that is my confusion. She is adding here 1.7 as other income, right? 207.8 plus 1.7. Okay. Now I don't know why is she doing so, because 209.5. Because
okay, one second. Can I just, so the definition is you have to take the operating profit before exceptional items and other income. This is by definition the formula, right?
Yes.
Now, if you go back to this report, I just want to look at the numbers.
Yeah. Here you go.
So I have like two concerns. The first is even on the 2008, I can't see the whole thing.
Yes, Asmar, yeah,
Okay.
that's better.
Yeah. So in 2008, technically, economic hedge contract gains and losses is also an exceptional item or a source of other income, whatever it is. It was not part of the segmental operating profit of 266.3, but she added it to calculate 269 or 8.9, whatever that is. And that's also similarly in 2007 she considered other income.
That is
Now,
because
how is she deciding this? Although the formula says you exclude exceptional items, yeah.
Ahmad, the economic hedge contract, if you remember the question says economic hedge contract and gains is part of this. If I go to the question, it's very interesting. If I go to the question, where is the question for this 4.9? I need to go back to 4.9 now. If you go back to 4.9, this is what I specifically remember. If we go to 4.9, I'm just quickly doing it. See here, before you start calculating the ratios, it is important to realize that we're going to see ratios related to the business operations. We therefore have to exclude exceptional items from the revenue and operating profit. Note, the economic hedge contract is not considered.
Okay, got it.
Got it?
Got it.
So economic hedge is fine.
Okay, economic, so she gave a note that we considered that as, okay, it's not exceptional item, include that in the operating profit, understood. Still, then other income is now the question mark. Why is she including that?
That's true.
Exactly. And also, this is in contradiction, Hamad. I think this is in contradiction to her own, oh God, just a second. To her own formula, which is here. Which is here, if I go back to, oh God, just a second, if I go back to lectures, the same 110 minutes, 106 minutes, and if I go to 60, you see this, just a second, see this screen, profitability, which profit? You can see this, right?
Yeah, profit before exceptional items and other income, yes.
So maybe guys, she made a mistake by adding that 1.7.
It's possible, I was thinking the same.
made a mistake. I think she made a mistake, but because again and again she's saying in the lecture also that you have to compare operations only, and so I think she made a mistake, or some TA made a mistake adding that 1.7, and this mistake would not have been there if the year 2008 had something in the other income here.
Yeah. Also, one more thing is what is considered as other income. Your annual statement, your annual report defines two different items, and if you want to like select which one is going to be part of other income, which is not going to be part of other income, you need to really understand how that income is coming into play, whether it is part of operation somehow or not. Like for example, my report has very different information. So Sami's report will have also different items in the exceptional items. So it will be difficult to align ourselves on what exactly to consider. I think she made a mistake.
I think she made a mistake.
To be on the safe side, we considered operating profit before exceptional item and other income. So in your case, it will be the number you are considering right now.
Absolutely, absolutely. Thank God. So first thing is done. Now we are clear. Now, okay. Now let's move to and it's already 10:34. So let's move to the next thing, which is just a second. Return on that's what you can understand. Return on sales is net profit. Yeah, there's one thing also she says, return on sales, which is net profit margin. If you see these two lectures, my sheet will be clear to you. These 106 minutes, the last 60 minutes, and also the IMI feedback video. So I will not spend time on this return on sales because she said that you need to do. And I've done this because for engineering, these three make sense. The return on sales, which is the net profit margin. Now imagine, Sami and Ahmad, for net profit margin ratio, and I've used the same wording also, for net profit margin ratio, what we had to do, what the book says you need to divide net profit divided by sales, right?
Right.
And net profit in this case, I have deleted net profit because we are and INI is also an engineering I have deleted net profit. Why I have deleted net profit, I'll tell you now. Because there may be a confusion to you also that how can you calculate net profit, Asmar, by dividing operating profit before again the same thing by sales. So here you go. Here is the answer.
And we want to make a comparison, we will use end values, as we do not have enough information to calculate the averages for both years. In 2008, we find 25.5%, and for 2007, 24.5%, which is a slight increase. The gross profit margin, or gross profit ratio, is calculated by dividing gross profit by sales or turnover. In 2008, we find 40%, and in 2007 also 40%. For the net profit margin, we divide the operating profit before exceptional items by sales.
Did you hear what she said?
Yeah, I heard what she said, and it also contradicts with the formula she wrote.
Yes, and now see the numbers down there? See the numbers down there? And there is the number is the same which we just discussed. 0.909. And she gives an explanation. She gives an explanation of this. I don't remember here or in that lecture. Listen to this.
We take operating profit because we are interested in the operating activities of the company.
You hear that? That means just again.
So
because in the
what you're saying, guys, for this particular ratio, we still use the operating profit, not the net profit?
Yes, and the same operating profit except minus exceptional items, minus amortization, minus other income. So that we are comparing the, again, let's
or turnover. In 2008, we find 40%, and in 2007 also 40%. For the net profit margin, we divide the operating profit before exceptional items by sales. We take operating profit because we are interested in the operating activities of the company. For 2008, we find 14.1%, and for 2007, 13.1%. A slight increase, which means that IMI was able to generate more profit per unit of sales. The asset turnover is found by defining SIG.
Interesting.
So, and this is what I have mentioned in the, and this is called return on sales, which Marco, the other guy of FMA, in one of the lectures, he mentioned. So return on sale, just a second, let me just put it here. We are taking operating profit before exceptional items because we are interested in the operating activities of the company. I just copy pasted professor's comments. Now, this return on sales, and I have given net profit margin as in, but the main name of the ratio is return on sales actually, which is in conjunction with one of the lectures of Marco on the hub. So now if you multiply, to verify this, professor says a bit later, Holande in this one, to verify this calculation, here I've made the calculation as per this formula. But to verify this, we can use another formula, return on sales multiply by asset turnover. So if you multiply this return on sales with asset, because if you had used a different formula, if I had used a different formula, net profit, this multiplication would never be satisfied. You understand what I'm saying?
Yes.
So this return on sales, if I multiply this return on sale with asset turnover, 3.29 multiplied by 6.4, I will get 21.2. I will multiply it right now. 6.4 multiplied by 3.29, I get 21.2. So asset turnover again is sales divided by total worth. That we already know. So debtor collection, debtor this, profit, gross profit margin, we already know. We are not interested in gross profit margin that much. To be honest, we are interested in return on capital employed.
Yeah.
With return on capital employed, the two things which are linked, return on sales and asset turnover. Other than that, debtor collection period and creditor payment period. These two things are anyway important for any business these days. But there is some commentary which the professor makes. So I would again recommend that you, for the exam preparation and everything, you read the commentary so that you know which days are good or which days are bad or whatever.
So you're saying we should consider basic three formulas are the ROCE or whatever they call it, and return on sales and asset turnover.
I think we should use all the formulas that because I have removed some of the formulas. I think these all formulas we can use because gross profit margin anyway. I didn't write the commentary here. The gross profit margin means the value that the market attributes to your product. If you are a luxury brand, if you are really high value, this is the value.
Is that relevant to our, because we're not a retailer, right? We're an engineering company which is selling consultancy.
Hamad, this is important in a sense that how the customers or how the market views that what is the value of engineering service that you're selling. If they are willing to pay my company, Hamad, in 2015, 40% of margin on my services, and your company, they are willing to pay you 20%, which means the value of your engineering service is half of the value that I provide to the market. You understand the analogy? So you cannot say for example Gucci or Armani, this gross profit is 80% or 90%, and denim jeans would have this gross profit 20%. So the way Gucci will look down at denim, it would exactly be the same as if I would look down on the other company which is 10%.
No, I understand the principle behind it. No, I understand that from the lectures. I think he gave examples of retailers, shoes, and also supermarkets. So it's easy to sort of pick up on that. I'm just thinking how it sort of relates to engineering companies that are selling consultancy services. All right, fine. We can consider it, but we also need to understand how it helps us understand a specific, a specific element about companies which relates to the end goal, which we're going to reach at.
You're right. And I personally view it as a market perception of our company. Say, and actually also, if you, Hamad, if you are a customer and you would like to hire a consultant, obviously a consultant like Arup or a consultant like Atkins, we would think, oh my God, they would be really expensive. So why don't we have a small? Why don't we hire a smaller company like
go for a smaller company? Okay.
But that perception is actually this gross margin, and based on that perception, those companies charge high gross margin. You understand? So that we can give it a spin. But you're right. It has to be welcome. Anyway, let's move to the next one, which is so we are clear on the first 6 ratios right now.
Yes, we are clear. Thank you very much, Asmar, for the explanation.
Okay. Now we have liquidity. Liquidity is not a problem. Current assets divided by current liabilities. We all have these numbers. A ratio of 2 is often considered ideal, but depends on the industry. The lower it is, the more worrying sign it is. So my is 1.2, 1.3, which is very bad. And it will be hard for us to pay the short-term debt. So I have also mentioned we are not calculating quick ratio, as in our line of business, inventory doesn't have much role to play. And here I have mentioned grave concern, as we might not be able to pay our debt. So my ratio is 1.2, 1.3, 1.2, which is very poor. It should be 2, then it should be satisfactory. Okay, so now let's go to the next one, which is gearing. Now gearing is interesting. Gearing is, okay, gearing adds a lot to the complexity now. Let me just get to the gearing. Hamad, I was telling Sami that today, whole day in the office, I couldn't work. I went to the office 1 hour early this morning, and I thought within 1 hour, I'll just do it. And then when I checked, and I was by myself, and I said, what the hell is that? And so, okay.
You have a cool office that you can spend 12 hours in the office not working. I can't even imagine myself doing that.
Oh my God.
Now let's go to gearing. Gearing is, okay, here you go. Now I'd like you to listen to the gearing thing. Okay, here you go.
Which brings us to gearing. We calculate gearing by dividing fixed return finance, which is long-term borrowings plus preferred shared capital, by total finance, which is equity plus short and long-term loans. Bank overdraft is excluded as it's considered a cash equivalent.
Okay. So, getting back to the, there are 3 things which she has mentioned. One is, what is a fixed return finance? And I did a lot of Google research also on this one, which verifies this has come from Google. So the gearing is, actually, it is the degree to which a firm's activities are funded by owners' funds versus creditors' funds. Because anything that the firm has to do, it has to be funded by somebody, right? Either it is funded by the owner's equity, or it is funded by creditors or banks or lenders. So one of the best examples that they have is called debt to equity ratio. And actually what Hollande is mentioning here, this one is debt to equity ratio, which means how much debt do you have and how much equity plus debt total. So the formula is short-term plus long-term borrowing divided by short-term plus long-term borrowing plus total equity, which means the overall money which funds the business should be down there, and then So this tells you that your overall, so a percentage below 50% may be considered acceptable, which means that you have enough equity to fund, you will be able to pay this short-term and long-term borrowing. Now, to prove that, let's go to the numbers again. So the numbers are what she has mentioned: 371.5, 46.5, which is short-term and long-term borrowing. So if I go to IMI again, so the short-term borrowing of IMI is current liability. So current liability in this case is short-term borrowing is 46.5. Okay, 46.5 is interest-bearing loans and borrowings, and this is in a current liability section, so this is short-term borrowing. And she mentioned that bank overdraft is not borrowing, is not short-term borrowing. So otherwise we would have included bank overdraft. Anyway, so 46.5 we are including as short-term borrowing, which again I would get back to the same screen, 46.5 as short-term borrowing. And long-term borrowing is 371.5. If I go back to IMI for long-term borrowing,
my company has no borrowings. They're only long-term borrowings.
okay, so the long-term, where the hell is long-term borrowing? So long-term borrowing is liability, current, this is long-term. Okay, this is long-term borrowing, 371.5 in non-current liabilities. Interest bearing and loans or whatever, 371.5. So 371.5 plus 46.5. And if you go down again, 371.5, 46.5 plus 461.7. So 461 is total equity. And if I go to this freaking thing, 461.7 is the total equity.
That's a net asset, isn't it?
It has to be equal to net assets, yeah.
Oh, okay, yes, that's right.
So the total equity, so what I've done is, in the Excel sheet, let me now get back to the Excel. Now in this Excel sheet, what I have done is here, I have put a total equity column. Now total equity is actually total assets minus total liabilities. So Sami, it is, I'm afraid it's not net assets, because net assets.
Asmar.
Oh no, you're right, it's net asset. Okay, that's called
Asmar.
net assets. So,
Asmar, if the exam question is all about this, I will come to Dubai to give you a hug.
No, why I was spending a lot of time, you know, it's this 50% coursework is fine. There is one question about, she mentioned there is one question about, she will give us a sample of financial report, 3, 4, 5 pages. We will have to go through that. We will, this will be there. So that's why I, so this, so okay. So net assets, Sami, you're right. Net assets is the total assets minus, what is that? Total equity is equal to net assets, you're right. Okay. So now we have, so we are clear with gearing. Gearing is all okay, right?
Yes, clear.
So what you're telling us, Asmar, you've used the same gearing formula that she used on the hub?
Yes.
This is the same formula. This is the same formula.
Okay. Okay.
Only thing is I have added gearing ratio. Yeah, there's one catch to it also for the exam preparation. He mentioned gearing ratio short and long term. She may mention, and I think let's listen to this here. I think it's here or either in the long run.
The numbers for these calculations can be found in the balance sheet. Gearing for 2008 is 47.5% and for 2007 42.9%. A percentage below 50% may be considered acceptable. The ratio for 2008 is near that mark, which suggests that there's not much potential for more long-term borrowing if necessary.
Which means it's not here. So we need to go back to the lectures, because that's why I put in Excel here, short and long term. This one, and here we go. This is asset turnover, debtors collection, creditors, inventory turnover, gearing. Okay, just a second.
Gearing with short and long-term loan included. And what you see that there's a large jump and from our competitors. So those are numbers that we can easily compare and see what's going on. Okay. Now we move on to the balance sheet part, and we look at liquidity. And liquidity, basically what we want to see, we will compare faster than current assets. So therefore our ratio. A large increase in the interest-bearing loans in the short term. And because of that strong increase, the gearing, actually what you have, it tells you that you have to pay attention. Because basically you can do gearing and just take the long term, but then since this one went up so much, you also want to calculate it, including this number, and then compare what happened and how far, what percentage are we ending up right now.
So Hamad, did you hear what she said?
Not particularly. Can you repeat it?
Yeah. So to your point, your company doesn't have short-term borrowing, right?
Yes.
Okay. Now, if I go to IMI, what she's saying is, she's saying usually it is a long-term, if it is a long-term borrowing, gearing is the long-term borrowing. Your ability to check the debt-to-equity ratio is whether you can pay your long-term borrowing or not, or whether you have enough equity to pay. So why we are taking short-term? She mentioned here that if you see the current liabilities here in IMI, she says that in 2007 it was only 5 million, and in 2008 it is 46.5 million. So she's pointing an arrow here, and she's saying that, which means the company has taken a lot of short-term borrowing recently in 1 year, which means we have to include this. So that's why she said once you are making a comparison, either you make a gearing ratio without short-term, or if you are including short-term, then you should write it as like this: gearing ratio short and long-term. So this formula can be flexible. If it's not short-term, then we will remove short-term from here and short-term from here for any exam purpose.
Okay? And only on long-term.
Yeah.
In your case, in the company you're considering, are there short-term borrowings?
I have made two sections here. If you fill this table, you see I have made this one. Short-term borrowing for the year, current liability, yes, it has 59, 55, 61, 2013, 14, 15. And long-term borrowing, 49, 45, 50.
So you are considering it. Okay, so I mean, then we should all consider it. If we don't have short-term borrowings, of course, then we don't.
Then you consider it.
Yeah, we just put that as 0.
Exactly. So that's my point. We all that's why this table is there. So we all put whatever that is.
I mean, in my current liabilities, I'll just read it out quickly. It says trade and other payables, current tax liabilities, derivative financial liabilities, and provisions. These are the 4 items under liabilities. None of them is related to borrowings. Okay.
None is related to. Okay. Perfect. So you got the point, right?
Yes, no, it's clear. Thank you very much for pointing these things. Honestly, whether we put it on the report or not, but for our exams, this is damn important. Thank you.
I don't know. There's so many other things could be there, but whatever.
I don't know. There's somebody mastered this.
Now cash flow. Cash flow is not a problem. total cash inflow, cash outflow, fine. Other than that, what I have done is, this is the ratio which I Googled that because we were only doing one ratio, total cash inflow by cash outflow, which is okay, but cash is actually the king. So so I figured out that one ratio is the most important in business where especially which is the operating cash flow ratio. Operating cash flow ratio is this. I have mentioned here that this is our business specific, and I'll explain the number. It's very interesting. This is our business specific while comparing operations. We are only comparing operations here. We are not comparing cash flow from investing activities or cash flow from finance. Okay.
Why?
Now, okay. So sorry. So this shows, because it has to be operation versus I'll tell you why. This shows how many dollars of cash we could get from every dollar of sale of our service that we have made. Which means that if we have sold, because Hamad, the reason why,
let's say if you have sold $100 worth of
if you sell
consultancy,
yes, if you sell $1, you get 4.5 cents of cash in a year, which is not good. For every dollar of service that you sell, Hamad, you are getting 4.5 pence. And here you are getting 6.5 pence. So you are better in 2015. But still, maybe your company is much better on every dollar. So we will say, and why we are saying this? Because we are saying net cash flow from operations. And why? Because we are comparing it with sales and revenue, because revenue only comes from operations. It doesn't come from investing. It doesn't come from financing. So that's the answer.
So you're saying we should not include the cash flow from financing or investments. We can only include...
Look, and why we should not include? Because this is an operating cash flow ratio, cash flow at which you are operating. Is your business investing into other companies or other things or is your business financing? No, the business is actually unlike BMW case, in which one part of their business was car financing service that they give to their clients. Whoever buys BMW, he gets car financing also. That was part of the business. In that case, I would have included financing cash flow also with this and compared it with sales. But this engineering company, they can do investments under the table in 20 countries. They can do financing, but that is not. So the logic behind this ratio is that how much cash are you able to recover from every dollar of sale that you make, which is the lifeline of an engineering company business, which it doesn't sell or make any products. It has to be cash in, has to be there, because because their fixed cost is very high of the people. The people that they have is, see here, the head count is 18,000 people. Atkins. So if they don't have cash, how are they going to pay their salaries and their benefits and their dividends and everything? So in that case, and that has to come from operations. The basic premise of business is that it has to sustain itself. You cannot sustain operations from investments or finances by raising loan or by raising or making, then that business is not successful. You understand? If the business cannot sustain itself on its operations, on its continuing operations, then good luck to that business. So that's why this ratio is a good indication of that we are not going good on cash collection. And it shows from here also that your sale is 2,000 million, 1,700 million pounds, and your cash flow from operating activities from the business is just 75. for the year. Anyway, it's very bad. I mean, it's not a, with anybody who could see is not good. So, and then we have the three eyes, and now for the three eyes also we need to be a bit. If you like, we can discuss the three eyes later, if that's okay with you. I can discuss it later, because a few things that I'm
okay, by the way, unless you got tired by explaining to us.
I didn't get that. It's my revision going on, so I'm okay with that. Yeah, let's quickly go. Okay, so intellect. What I've done is I have simplified these further. So these are three, these are two, then these are two also. So let's go by intellectual first. Amount of money spent on staff training or skill development. Clearly, I got 17 million pounds in 2013. So I put it in there. 17 million pounds. If you see 2013, 17 million multiplied by 0.75, which is, it carries 75% weightage. Simple. No need. Then the second is knowledge or capacity building or equivalent department or tool or initiative. This is a simple yes, no. It is a yes. They have a new online platform that is being rolled out to all the regions in 2013-14. And you know, the best thing to do is you don't have to spend a lot of time, because we will do a lot of commentary on this. So you can just do Control F, do the training department or something, training, you will get all the numbers. You do training, start control finding, you will have 30 Control Fs, you will get all the three if you just scroll down. So within 10 minutes you will get this. And then the last one is overall manpower count, including C-level executives and directors. And overall manpower count is 17,000, which obviously is a lesser indicator, 10%, but it constitutes the overall intellect that the company has. If a company has main manpower, and if the company has, and by the way, I wanted to calculate another ratio, which is that how much money they are spending total on their staff training and how much staff do they have. So how much money they are spending on kind of roughly, or maybe it could be more sophisticated on engineering department and all that, but let's not go there. So this is what they've done. So for 2014, so their spending is constantly increasing on their staff, and that's why you see the intellectual capital from 12.7, because we can call it points, 12.12 million points to 13 million points to 16 million points. So their intellectual capital is increasing because they're constantly investing in their team and including new systems and all that. And then I will make a commentary based on their training points that, oh, they have done this, they have done that, so blah, blah, blah. And this is what we all five will discuss. I will say when we will be advocates about our company, and we will probably have 1 minute each. And I will say, oh, my company Atkinson does this in training and that in training, while we will be making final judgment on picking one company, right? So I will have these points, and I will make this in my comment. So let's go to the second one, innovation. Innovation is amount. Now this is very interesting, and I really enjoyed calculating this. And it's a bit tough, but I'll let you know how. Amount of money spent on R&D, and I really here I want to know what details do you have in your annual reports. Amount of money spent on R&D, including any amount spent on developing or earned from selling new products, patent solutions, licenses, this, and any benefits in terms of tax credits or rebates on account of R&D. Innovation, basic premise, research and development, right? That's why it is 70%, right? Now, what Atkins has done, and maybe the UK-based companies are, that they get tax credits, savings on tax. I will just point out one, which is, let me open Atkins. Let me close Emmy. close this one. Okay, here you go. I have noted down pages from 2015 sheet, so I will open 2015 because otherwise this will take me a longer time to come up with. Okay, 2015. Okay, 2015 is, if I go to page number 143. Okay, 143. Okay, here you go. Where is that?
I just saw it, R&D.
There are, just a second, I think research. Research. 2013, 14, 15. No, not 2015. 2015 is straightforward. They have just mentioned. Okay, let me just do it. 2013 research. CR research. Okay, here you go. Yeah. Okay. Now, if you see this, it says that in UK statutory law, the income tax in 2013 is 24%. Okay? And it says, but the effective income tax rate, which they have mentioned in the income statement, is 14.4%, which means that Atkins was able to reduce, and it took a little bit of time for me to understand that, and I'll let you know how, that instead of 24%, Atkins paid tax on their income, on profit before tax, at 14.4%. And in this 14.4%, the savings of 5.6% was through research and development tax credits. So this is the amount of money which Atkins was clearly able to save or make that has improved their bottom line. Okay, now how did I calculate this? This is not a number. This is not 5.6 million. This is a percentage. How have I calculated this? So if you keep in mind that their tax is 14.4%. Okay, now let's go, and the saving is 5.6%. Now if I go to the income statement for 2013, okay, here we go. Income statement. It says that profit before tax is 103.3. Yes, profit before tax is 103.3. If I come to the Excel and I write here 103.3 multiply by, if I multiply this with the overall tax number percentage, which was 14.4. 14.4 is multiplied by 0.144. How much is the income tax that was deducted, Sami, income tax for the year? 14.9.
Right.
On 103.3, at the rate of 14.4%, which I showed you before down there, the rate is 14.9. So which means that it is the same how much they were able to save 5.6. So if I do it again, so what I've done here is, if you see the formula, 103.3000, which is this one, 103.3000, 103 million, multiply by 5.6. I'm back to the same page. By the way, there are two which are sometimes it's confusing. There is effective income tax and there is underlying income tax. Let's not see underlying income tax because they have not done based on 17.4%. That is underlying effective income tax. That's the figure that they have generated. Let's not see this. We have to see effective income tax, not underlying effective income tax. Okay?
Understood.
So 14.4, if we multiply it by 14.4, you get the same which tax actually Atkins paid. And they saved 5.6%. And this saving I am capturing here by multiplying the same operating profit, profit before tax, multiplying it by 0.56, 5.6%. And so they saved 5.7 million pounds by spending on R&D. And so this explanation I gave in one line, but I will do in narration. So this is a clear that they have, because they have not disclosed the numbers. Why? Because they have not disclosed the numbers, how much money they are spending on R&D. While I was doing research on their annual report, I came out with. So this is another way of putting that, okay, whatever amount of money that they are spending, they have not given the details of their actual expenses. I've searched it. If you are getting the actual, you can mention that. And if you are getting tax refund, you can mention that also. Clear? I wanted to. And the same goes here. In 2014, they save 6% on tax. So 6% multiplied by their profit before tax. And in 2015, they have mentioned explicitly that they have saved 5 million pounds in tax by spending on R&D. They have gotten the tax refund or whatever. I think if we do something like this, this will have an impact on somebody who, and I verified these calculations in front of you right now. I've already done it for 2014 also, that it is the same rate they are using. At the same rate, if you do, you get the profit before tax. So now so what you can do is you can just type research in your annual report and see what comes.
Understood.
Understood?
Yes.
Okay. Now, just a second. Let me. Okay.
Asmar, what is overall headcount, including C-level executives and directors? This is their payroll?
Yeah, 17,899 for 2013.
That's the amount they are paying to the C-level executives and directors.
No, I have here the thing is the overall headcount.
This is the number of oh, this is the headcount. Okay, sorry.
This is the headcount. This is the headcount. So now the second thing is there an incentive plan in place for promoting innovation among employees? This is more qualitative. Yes, yes, yes. And they have things and they have blah, blah, blah. So that what, yeah. So which means that their innovation capital is actually decreased a little bit. And that's what is that they spent less. So that's why they got less rebate. And the best year was 2014 when they spent more. So there's like from 4.3 to 5.1 to 3.7. Whether we use it in terms of millions or we divide it by something and put a point number, whatever. But these are the overall points. I think we can keep it like that, and we can say, okay, this is kind of a up and down trend. So, and of course, you cannot be, and this is clear indication, you cannot be innovative. I mean, you should, if you're in engineering, but being innovative all the time is a cost. So as in the case of intellectual, but interestingly that they are spending a lot of money on improving their intellectual capital, but innovation, they are probably, we just have 3 years of data. If we have 5 years of data or 8 years, so this graph would be more clearer. So I would put in my commentary that which means that they are preferring training their people and improving their intellect more than coming up with newer and newer products and R&D, which is understandable. That's their, but whether this is in line with their main strategy or their vision, I will comment on that also by pasting their vision, that what do they, their directors prefer most. And the third one, so the last one is the integrity one. This one I struggled with also because I did not find any. Okay, the last point is evaluation of auditors' reports and notes and accounting policies. Is it all good? Does it have some improvements by the auditors? Is it major discrepancies that they have reported? So of course this should be all good, all good, all good, and they are Atkins, they have reported everything good, so directors is all good. But this thing, which is amount of money spent on health and safety, corporate social responsibility, sustainability, charity, social work, community support, helping the deserving within the community, but this charity does not include political donations. So what I have done is I have taken one element, which is donation, and I've mentioned it here, non-political charity. What Atkins has done is in 2013 they spent 139, because this is a big thing. If a business, so if I open, the last thing is if I open 2013, which is this, and I do Control F and I do donations. By the way, they do a little bit of political donations also. There is a little bit of hanky-panky going on in their accounts here and there. So they say, just a second. So they say the group made no political donation and incurred no political expenditure in the UK. But in the US, they made something. They say in the US, actually in the US, they made $18,000, which is a small, no, during the year ended 31st March, corporate political donations in the US is 18,000 were made and 4,000, okay. In addition to this, charitable donations. Now, I have not taken account of political donations. Charitable donations, during the year, the group has made charitable donations of £139,000. The beneficiaries of these donations were local charities serving the community and blah, blah, blah. So, I have put it here. In 2014 and 15, they have not done any charity, and they have not disclosed their expense numbers on spending on health and safety and improving HSC and improving sustainability. They have not given any breakdown of numbers. So I have not put in there. So I've clearly put in that this has gone down. But I am researching on it a little bit more if I get more numbers and all that. By the time I reached it at 8 o'clock, 9 o'clock tonight, I was almost drained out. So I couldn't do much, but at least I came up with some numbers that we have that they did. So that's that.
Very interesting, Asmar.
So that's what I thought that we should, and that's why I wanted to talk to everybody, that at least we should, because this could be a disaster if all of us do it a bit differently, and not only differently, use different numbers, and then get caught. Because I think the only thing which these guys are going to check, one of the 2-3 things they are going to check is this whether we are sync or not. Because if we are not sync, then probably the guy will not read the rest of the report, and he would I don't know. So that's why I found it very critical that whatever we are doing, we are at the same page.
Actually, yeah, this is important. Arbitrarily, they will probably pick a 1 ratio and make sure that all of us did the right calculations for those ratios. and we better be very, very careful on using the same exact calculations and formulas and understanding. That's very important.
Okay, so this is okay. So I think the session is being recorded. Sami, now you can stop the session if it is recorded with the video.
It's all recorded. I will download the video and send it to you guys all. Obviously, I will not be able to send this through email. I will use WeTransfer or other services for you to download this video, okay?
Perfect. Thank you so much, Sami. I appreciate it, honestly.
Oh, anytime, brother. And I don't...
No, thanks a lot, Asmar, for this useful session. Really, it's a lot of help. Good revision. I'll also go through the 3 I's. I'm just a bit confused if I will be able to get out all this information. We might have different companies in doing different things. But let's try to get on the same page. Yeah, I'll try to follow your formulas.
You can add.
And if there is something I can add, I will I will add. But I'll try to follow what you did. If I'm able to do it, perfect. If there's something else I find out, I can of course add to it.
Perfect. Perfect. And we can, because the parameters, and then we can tweak the definition also for the I. But the parameters have to be the same. Maybe some parameters are 0 for, like short-term borrowing, 0 for you, but for me. So maybe the other company has reported some numbers on corporate social responsibility. So I will put 0, you put a number. So exactly that's the perfect.
Okay. All right. Okay, good. Fine.
All I can
Thanks
say
a lot, guys.
You hijacked my study time.
I was also revising. I had to revise teams and groups and all that today. But this today was, oh my God. I was banging my head here and there, and I was like, she's doing something else. She's writing something else. Book is saying something else.
One question: were you able to register for the exam?
I
did that.
I'm not able to do it. I tried twice and I wrote to them. They haven't replied yet, but I'm not able to register. So when you click on the link they sent us, and it takes you to University of London website, correct?
Correct.
And then you try to register with your CID, date of birth, and your email.
Yes.
Okay, so for me it's not working. I'm kind of freaked out because Friday is the last day. Anyways, I'll call them if they don't reply by tomorrow.
Oh, absolutely. They would should be able to register you if at least you cannot do it yourself.
But did you get
yeah,
your card?
definitely. And I also haven't gotten my card. I don't know where they sent it. So it's been like what, 10 days or 12 days there. I haven't received anything. So I followed up yesterday on it. I guess worst case they will send it by DHL. Print it again and send it again. I don't know. I hope they did not send it by post because you know how Middle East posts are not that amazing.
No, very poor. Yeah, I think you should have told them that send it to you by DHL or FedEx.
Previously, they have been sending everything by DHL, so I thought they will do the same. But I just I'm gonna reply again and ask them to do it. Anyways, thanks a lot, everyone.
Yes, thanks
you very much. Asmar, especially.
Yeah, absolutely.
Thank you. Thank you, Sami.
All right.
Talk to you guys soon.
Bye-bye.
Good night.
اللهم صل على محمد وعلى
سبحان الله في البدو قال لك يلا.
لا تخرجي دحين. خرجتي؟
وين خرج عندك يلا.
كويس. عندي شغلة بسويها الله يصلحك.
ما علي دخل يلا. طب تاخذ وقت يعني؟
يعني تقريبا نص ساعة كذا على 11.
أنا عندك يلا.
طيب خير إن شاء الله. مع السلامة.